Hello everyone, welcome to this episode of Your Life, Your Money. Mutual funds in recent years have become very popular. While on one side, mutual funds have become very popular, there is an enormous amount of ignorance about how to invest in mutual fund, the points that need to be kept in mind, how you can better perform your mutual fund portfolios. So there is a great amount of ignorance. This video I have done keeping in mind all these things which has come to my notice, and this is a beginner series for someone who wants to start a mutual fund, how they can move one step at a time, trying to understand mutual fund, all its advantages, disadvantages, do's, don'ts, and other things. If you are interested to invest in mutual fund, you should watch this video to the end and don't miss any of these points. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, first let us try to understand what are mutual funds. Mutual fund has two words, mutual and fund. Fund refers to a pool of money. Mutual refers to collective. Otherwise, more people join together, pool their money, and they get hold of a professional fund manager to manage their money. This is the broad way of understanding the mutual funds. Mutual funds are generally run by either banks or industrial houses or foreign institutional investors. You have heard about mutual funds from HDFC, ICICI. You've also heard mutual funds from Tata's and Reliance, Nippon, all these industrial houses, as well as foreign institutions, Franklin Templeton, JM Financials, and others. Many people get confused with mutual fund investment and the stock investment. People think these are two different investment. The answer to this is no, they are similar. For example, the easy way to understand mutual fund and stocks is a mutual fund is like you want to go out for a restaurant for a dinner, you take a buffet ticket. That's a mutual fund. So you have a spread of menu there and you can choose whatever you want according to your taste and what you look for, and you can fill the plate accordingly. That's a buffet ticket that corresponds to mutual funds. On the other side, you want to go out for a dinner and you order what you want. An a la carte menu represents something like picking up the stocks directly. If you're somebody who is invested in the mutual fund, you might have a question, should I still buy these stocks directly? The answer is no. There is no need because the underlyings in mutual funds, which is popularly is about the stock market. I'll dwell more about what mutual funds contain in a while from now. So if you have stock related mutual fund, in my personal opinion, there is no need for you to individually pick up the stocks. Both represent the same underlyings. Mutual funds have got stocks underneath that. There is no need for you to buy the stock separately. You don't buy an a la carte menu when you have ordered for a buffet ticket in a restaurant. That's the way you have to look at it. Why mutual funds have become very popular these days? Mutual funds have got tremendous advantages. The advantage is mutual funds are not contractual. Anyone can invest in mutual funds as long as your KYC is completed. There are no restrictions. You can invest with as little as 500 rupees or 1000 rupees. You can invest that way. So it's non contractual. You don't have to get into a contract to say that I pay for 5 years, 10 years, 7 years, whatever it is. Accordingly, you can invest as per your convenience. They are divisible in nature, meaning let's say that you have put a lakh of rupee in a mutual fund account and you just need 5,000 rupees. You can take out 5,000 rupees. You can allow remaining amount to remain invested in the mutual fund. If you have put your money in an FD, that option is not available for you. You have made a 1 lakh rupee FD and you need some 5,000 rupees. You have to either break the entire FD or ask the bank to give an overdraft against the FD and use the money. Whereas here in this case, it is divisible. It is liquid in nature. It does not have a tenure which is built in it. It's not like an FD which has a 5 year tenure, 1 year tenure, 10 year tenure. Here, mutual funds are at will, and on any day when the markets are open, you can sell these, and within 2 days to 3 days' time, you get your money back in your account. So these are non contractual, these are divisible, they are liquid at all times. There are two other major factors which makes mutual funds very attractive. One, they can potentially give you much higher return than a fixed deposit. While people ask you to invest in mutual fund quoting 12, 14, 16% rate of return in the long term, but in the short term, it can give any kind of a return. But it's safe to assume that they will give you a much higher rate of return than to get fixated on any specific number here. So you get a better return in mutual funds. You also have a tax arbitrage. Let's say you are invested in a fixed deposit. Every year, your interest you earn in a fixed deposit, if it is an NRO FD or for a resident Indians, the exceptions being the NRI FD of NRIs. So the interest that you gets accrued will be taxed as per the slab rate which is applicable to you. However, in case of mutual fund, the taxation occurrence happens only when you sell. You invest in mutual fund, let's say for your retirement, and you don't touch this money for 10, 15, 20, 30, 40 years, you are not liable to pay any taxes till you walk out of this. So it works like a deferred taxation. For those people who are in a higher tax slab, so this has a tax arbitrage in the form of reduced taxation. Let's say an individual's taxation can go up to 39%. Normally, people in a higher tax bracket will pay 33 to 35% taxes. Whereas in case of mutual fund, one, it is a deferred taxation. Second, the taxation will be around 12.5% in case of equity fund. So you have a deferred taxation advantage, you have a lower taxation. So these things make mutual funds very attractive to invest for each and every category of persons. Some people ask, I am a lady, can I invest in a mutual fund? By all means, madam, you can definitely invest. So it is not gender specific to males, it's aggressive. No, there are enough types of mutual funds which you can invest. If you are somebody who is of a conservative mindset, you can choose conservative funds, you can choose hybrid funds. There are various categories of hybrid funds which are available, which you can choose according to the comfort that you have. I told you about the advantages of mutual fund. The story is incomplete if I don't tell you the disadvantages of mutual funds. The mutual funds, what is the disadvantage? Mutual funds generally work very well when you have long tenure. You say that I have some money and I'll park it for 6 months, 1 year, 2 years. Anything can happen in mutual fund. The invested amount may grow, invested amount may stay static, or it may also come down in its value because of the volatility that you get in the market. However, if you invest in mutual fund for longer duration, how long? Generally from 3 to 7 years, ideally from 10 years onwards, it is impossible that you lose money in mutual funds or you get anything lesser than the fixed deposits. So the disadvantage of the mutual funds is they are volatile in nature. They are not suitable for parking short-term funds in case if you are investing in equity fund. If it is for short-term, the place where you can go is the debt funds. You have funds like liquid funds, short-term funds, ultra short-term funds. Specific category of funds are available in case if you are investing for short-term period. Investing into the stock market related funds will require longer time horizon. If you do not have longer time horizon, please do not invest in equity mutual funds. One of the doubts people have in their mind is moment they speak about mutual funds, the thought that comes to their mind is it's all about the stock market and the mutual funds are very dangerous. The truth is, mutual fund is just not about the stock market. Mutual fund is a very broad terminology. As I said, mutual plus fund. Anything where the pooled funds are there, that can be categorized as a mutual fund. Then you have to decide what category of mutual fund. Is it a debt fund, which behaves like a bank FD? Or is it an equity fund? Or is it a real estate fund? Or is it a gold fund? What is the kind of fund that you are getting into? So while the mutual fund is a very broad terminology and people generally use it as in synonymous with equity investing, but mutual fund has got all kinds of fund suitable for every person who has an appetite for whichever the type of asset class you have. You have got mutual funds in real estate today, gold. You have blended funds like debt and equity combined. You have arbitrage funds. You have got the short-term debt funds. You have got ultra high volatile sector funds. All kinds of funds are available in mutual fund. So don't be under the impression that mutual fund is only about the stock markets. Now let us look at how you can get started with investing in mutual funds. What are the prerequisites that are required for you to invest in mutual funds? Number one, you must have a bank account. You can't bring cash and say that I will invest in mutual fund. That's not possible. So you must have a bank account and you should have an online operating bank account. See, gone are the days of operating with check. Maybe still they accepted, but today, if you don't have an online banking, you can consider yourself unfit to be investing in a mutual fund. That's the extent to which advancements have happened today. You should also have an email ID, meaning you should be internet savvy. You should have a mobile number and you should be KYC compliant. If you have these prerequisites, email ID, mobile number, KYC compliant, and a bank account which can be operated online, you are eligible to invest in Indian mutual funds. A question that comes here is, I use the words KYC. What is KYC? A KYC stands for Know Your Customer. So when you invest in mutual fund, you can't invest like a Benami account. The mutual fund should know who is the person behind it. So they make every effort to know who you are. What is that they want to know about you? Your photo, how do you look like, and an ID document. Where do you live? Your address proof. Your email ID, your telephone number. You need to be having a PAN card. If you are a resident Indian, then your PAN card should be linked with Aadhaar card. If you're an NRI who has an Aadhaar card and a PAN card, even in that case, your Aadhaar and PAN must have been linked. In case if you're an NRI or an OCI who do not have an Aadhaar card till now, then it's okay for you to invest with a PAN card which is not linked to Aadhaar card. However, in your income tax portal, you should categorize your PAN as something which is linked to an NRI. That must be done. An additional KYC requirement for OCIs and NRIs is your overseas address proof also need to be given. One another document which will go into KYC is known as FATCA declaration. It is all about international tax obligations. So while doing your KYC, you must declare a FATCA declaration. It means to say in which all the countries you are taxed. For example, you are a citizen of India, you are taxable in India and your PAN number has to be recorded. If you were to be living in UAE, you should also mention that you live in UAE and you can say it's not applicable or put the tax identification as 000. Likewise, you could be having a right to live in multiple countries. Any number of countries where you have a resident permit and you can be taxed should go into declaration under FATCA. You should mention all these countries where you might be residing and the tax identification number of that particular country. Point to remember here is the information that you have provided here could be dynamically exchanged with the countries as per the international obligation under FATCA rules and regulations. Now, how to invest in mutual fund? To invest in mutual fund, you, apart from the documents what I mentioned to you and the requisite, you should also have a trading account. A trading account is where you buy and where you sell your mutual funds. Now, where can you open the trading account? There are multiple places where you can open the account. If you are working with a distributor of a mutual fund, they will have their own preferred platform. Somebody may use MF utility platform, someone may use NSE MF platform, somebody may use BSC MF platform. They have their own preferred platform for operating for their clients' accounts. You can also directly deal with the mutual fund houses in case if you want to go and invest directly with them. You can also invest through the banking channels. So each bank has its own banking channel to invest in the mutual fund. So there are multiple ways where you can use your trading account and you can invest in mutual fund. Now, let's say that you decided to invest in mutual fund and you have the requisite bank account, etc., what we discussed, and you have opened a mutual fund account. Then how do you infuse money into the mutual fund account? Two possible routes. One, I've got a lump sum amount of money. Let's say someone has got 50 lakhs. He can invest 50 lakhs upfront into the mutual fund. Of course, after taking the due care, instead of putting the entire 50 lakhs in one go, you may decide to spread it in on different dates. You may decide to hold it in a debt fund, and internally you can transfer it to the equity related funds at periodical intervals of time. That's a possibility. The other popular mode of investing in mutual fund is what is known as SIP. SIP stands for SIP, Systematic Investment Plan. What does it mean? You're all familiar with the word RD, recurring deposit in the bank. An SIP is an RD in a mutual fund account. You pre-decide an amount of money, decide the portfolio where you want to invest, and every month, as a disciplined investor, you keep investing into the mutual fund. So you have got two routes, a lump sum route or a systematic investment plan route. What are the advantages and disadvantages of lump sum or SIP investment? A lump sum investment works very well when the markets are down and you will be getting a large number of units at a lower price. However, you commit large lump sum amount of money when the markets are dancing at the top border. Then if the markets were to correct, you may feel sad that I should have delayed investing this money after some time. That's a possibility, it can happen. A SIP becomes a most preferred route, reason being there are no emotions in it. If you put a lakh of rupee into your account every month, irrespective of the market is up, down, whatever it is, you keep investing into it. Over a longer periods of time, it creates averaged out net asset value of your units, and you don't have to worry about what happens in the short term, whether the market is going up or coming down. You make most out of the market condition. Remember, in mutual funds, there is on an everyday basis, there is a good news. I repeat, when you invest in mutual fund on a daily basis, there is a good news. What's the good news? When the markets are in a bull phase, that means markets are rising every day, your earlier purchased NAVs are rising in value and you see valuation growth. On the contrary, if the markets were to be down, correcting, stagnating, then the amount of investment you make in an SIP account keep adding more and more NAVs into your account. So the market moving up as well as market moving down, both are essential for you to create a great amount of wealth over longer periods of time. If the markets do not correct, then you'll not have much of the units in your portfolio. Market going up works like a kind of, you don't have the units, simply the valuation is going up. So when the market's correct, also treat this is something as the juicy part of your investment. Now everything is ready, and now you have to execute your investments. How do you place your money into the mutual funds? So you have again two routes. One, go direct, you invest your money directly with the mutual fund houses, or use the services of a mutual fund distributors like us. When you invest your money through a mutual fund distributor, you get what is known as regular funds. When you invest your money directly with the mutual fund houses, you get what is known as the direct funds. There is a pricing difference between the direct funds and the regular funds. Generally, this pricing difference works out to about 0.5 to 0.6% when compared between these two funds. You may get a feeling that I lose half a percentage when I go through a mutual fund distributors. Please understand the economics behind a mutual funds distributor's business. When he gets this 0.5, 0.6, it's not that he'll be able to keep that money for himself. He has to pay 18% GST. He has to pay his income tax. He has to pay for infrastructure staffing. So this is a business of wafer thin margin. So it is very well justified that the sharing of the small difference makes worthwhile, and it gives you a lot of pleasant memories, and your investments can work without mistakes. So if you are somebody who wants to invest in mutual fund and you want the comfort of the guidance of a mutual fund distributor, you can make best use of services provided by NRI Money Clinic. We ourselves are the mutual fund distributors, and we can help you build the best portfolios, monitor them, guide you from time to time, and make sure your investments work very well for you. In case if you have such an interest, all that it takes is contact us by WhatsApp message on the number which is given in our description box below. We have also provided a link over there. Click on the link, it takes you to the WhatsApp, and mention that you want to invest in mutual fund, and our team of experts will be ever ready to help you. Why delay? Send that message right now. Now let's look at your path of execution of investment in mutual fund. I have told you about distributors and direct. Now let's look at how does the step-by-step process really works. Number one, first you decide what is the amount of money you are prepared to invest, whether it's lump sum, whether it is SIP, whether you want it for a shorter period, longer period, whatever it is. First decide the quantum of money you want to invest into the mutual fund. Two, identify a life goal. Your life goal could be purchasing a car, educating your children, your retirement fund, building funds to buy that property, site, anything it could be. Identify the life goal. Number three, understand what is the time available for you to work on that life goal. Let's say you are 40 years old and your life goal is retirement. You have 20 years time for you to work to build that money to create that retirement corpus. If your child is just 10 years old and child goes to college at 17 years, the time horizon that you have is just 7 years. If your plan is to buy a car 3 years down the line, the time horizon that you have is just 3 years. This is a very, very critical input. How much of time do you have decides what kind of a portfolio you build. The longer the time horizon that you have, you can build an aggressive portfolio. Shorter the duration that you have, if you try to make your portfolio aggressive, it can cut on both the sides. If things work very well for you, you may be sitting on good amount of money. If things did not go your way, probably instead of hoping for a great return, there could be, due to volatility, the money could have eroded. Both possibilities exist. So longer the time horizon, you can make the portfolio aggressive. Shorter the time duration, your portfolio should be tending towards the conservative side. Now you have decided on the amount, decided your life goal, and the tenure that you have. How do you pick up funds? How do you position your funds in which funds? What is the strategy to adopt? I would suggest a very time tested where I have extreme level of comfort and which I've practiced for decades together, what is known as a bucket theory or bucket concept of investing in mutual funds. What it means is, so we'll have two parts to the portfolio. We call it as a core portfolio, and the second is called as a tactical portfolio. Core portfolio is something which you keep money all the time, and tactical bucket or the tactical side of your portfolio is something which is used periodically. Okay, let's say now is the time for mango season. In the tactical bucket, we put the mangoes. Suppose if this is the time, it is the oranges, the tactical bucket may have oranges. I'm just telling you a live example how seasonality could change. Oranges and mangoes belong to two different seasons. That's how I took that example. Now, what is this bucket portfolio theory or works in practice? So there are three buckets. I told you about the core bucket, the core part of the portfolio, tactical part of the portfolio. That's one way of looking at it. And the actual execution, you invest this money in three buckets. Bucket one is known as conservative bucket. A conservative bucket is something which is similar to an FD or slightly more volatile than an FD, but it will not give you a high return like an equity fund. So you load in this something like a multi-asset fund, something like a credit risk fund, something like a liquid fund, or anything which is conservative in nature, and you have a small portion of your invested amount in a conservative bucket. What is the benefit of conservative part of the bucket? A conservative bucket serves like your emergency fund. It is not that volatile. This money is available to you all the time in case if an emergency were to arise, markets are not supporting to you, you can make use of the money which is there in conservative bucket to meet your immediate needs. Likewise, in case if the markets become very volatile and it creates opportunity and you don't have money to invest at that point of time, the money which is held in conservative bucket can be moved into aggressive bucket at such points of time. It serves multi-purpose. The equity related funds in your portfolio may not perform all the time. As I said, during a bull market, they will move up. During a stagnant phase or a consolidation phase, they don't move up, they don't fall down, they remain just stagnant. And during a corrective phase, their valuation can come down. However, the funds which are there in conservative bucket is always moving forward. It always creates a forward movement. Now you see what happened in the stock market since last 1 year or so, markets are stuck at about 86,000 or below. For one long year, equity market did not do anything for you. Whereas the money which is held in a debt bucket, whether it gave 5%, 6%, 7%, 8%, depending on the funds what you have chosen, it is still moving forward. It's a constant moving forward which creates in your portfolio. That's the role of a conservative bucket. The second bucket is known as the hybrid bucket. Hybrid refers to multiple things in a fund. A fund is a mixture of different asset classes. It will have equity in it, it will have debt in it, it will have gold in it, it has real estate in it, it may have international equity in it, it may have commodities in it. When I use the terminology hybrid, it's a very vast subject. It's not easy. It's very difficult to choose the funds in a hybrid bucket because let's say if I say multi-asset fund is a hybrid bucket and you take 10 different asset management companies, their multi-asset funds could be 10 different varieties of multi-asset fund. So it becomes practically difficult for an individual to pick up the right kind of a funds in a hybrid funds. What is the use of hybrid fund? Hybrid fund, as I said, is a mixture of different asset classes. As you all know, the asset classes do not perform simultaneously. Debt and equity will not perform simultaneously. When debt is performing, equity may not perform, and the vice versa. Likewise, gold, likewise, real estate, and commodities, and other things. So, when you have a hybrid bucket and the funds in it, since you are invested in different asset classes, you can be rest assured that under any circumstances, one or the other asset class keeps on performing. Likewise, the hybrid buckets, the funds, depending on the mandate the fund manager has got, could be changing the asset class from one to other. Let's say sometimes they may have more gold, sometimes they may have lesser gold, sometimes they may have more debt, equity, etc. But when the fund manager changes these asset classes, you are not liable to pay taxes. Without you paying taxes, the required changes in asset class happens automatically in case of hybrid funds. Having a hybrid fund in your portfolio, and if you have selected it right and if you have sized it correctly, can take away your need to rebalance your portfolio to a great extent. So hybrid is something like an all-rounder in a cricket match. Whether the track is spinning, whether the track is for the pacers, whether it's a batsman's pitch or whether it's a bowler's pitch, there is everything that an all-rounder can do. That's how the hybrid bucket works. A great deal of your money should come into the hybrid buckets. The third bucket is known as the aggressive bucket. That is where you bring in your equity funds. The aggressive part of the portfolio is the major part of your portfolio in case if you have constructed this portfolio for long-term investing. Again, it is building a portfolio there is something of individual's experience. If you are a do-it-yourself investor, if you are somebody new, somebody, I don't like to go with a distributor, I don't want somebody to help me, you might be thinking about a Google ranking and you might invest. But investing in mutual fund is a science. A science because whether I do, you do, ABC, do the things in a similar way, the results are same for each and every one. That is the scientific part of it. It's also an art. There could be thousands of funds. Which funds to choose from? What proportions to use? During which season you have to increase, decrease. So that is the artistic ability a seasoned mutual fund investor or a financial planner will bring to the table. You would have seen amidst musicians, you have the same musical instrument. But some people are called maestros. Why? They also have the same seven ragas, they have the same musical instrument. What makes them a maestro? A maestro is someone who is able to pick up that extra note, makes it silky smooth, or makes it so pleasing to your ears. That's why it's called a maestro. The same thing applies in case of mutual funds also. There are countless mutual fund distributors who have these artistic abilities. I have come across many of them. Some of them have been already interviewed on our channel as well. So you can make best use of these services. The last portion, what I told was the tactical portion of your portfolio, which is a sub bucket of the aggressive bucket. What is there in a tactical bucket? A tactical bucket is where you put something which could be a music of the season. For example, let's say if mid caps are doing very well, you can have a small exposure there. Or you may think currently banks are not doing well, but banks are essential part of the industry. But after some time, they will again come up. So I will put small amounts of money over there, give it the required time, and when its time comes, it will outperform. So such kind of ideas, the contra calls, the music of the seasons will get into the tactical bucket. A word of caution when you load your funds in a tactical bucket is, again, it's a very, very artistic ability of the practitioner here. One thing which can go wrong is you assume that such and such a thing will happen. That may not happen. So wherein which your portfolio may underperform. Therefore, when you invest in some of the funds in the tactical bucket, you must always keep an exposure control. Normally, during my practice, when I put a tactical bucket in it, I will not expose more than 20% of my client's money in a tactical bucket. Even this 20% will go into 3, 4, 5 sub individual funds to make sure that not the entire 20% will underperform. So that's the care we take. Let me also tell you some of the cardinal principles or observations you have to make or you have to keep in mind. Number one, the expense ratio. Everybody talks about the expense ratio. When they choose a fund, what they try to look at is the expense ratio should be lowest. Theoretically, there is nothing wrong in it. But let's understand it. Expense ratio as a selection parameter is overhyped. Especially in case of India, expense ratios are completely regulated. I don't think anyone has any right to dictate an expense ratio, whether it's an asset management company, whether it's a distributor or anyone. Every expense ratio is followed according to the metric given by the regulator. When a new fund starts, obviously its expense ratio will be higher. As it gathers funds, the assets under management rises, expense ratio keeps falling. So I will not check any fund based on the expense ratios. Rather, I will look at the suitability of the funds. Since it is highly regulated, there is nothing that you can do about it. Just because a fund has a lower expense ratio doesn't qualify it to be included in your portfolio. So if somebody talks to you about expense ratio, I'm talking specifically about mutual funds in India. However, I will not say the same thing with other parts of the world, and there is a dirty game going on elsewhere. So in India, expense ratio is not something which you can look at to weed out a certain kind of a funds. I'm not in agreement with that. Rather, I would pick up a contra fund which has newly come into the market, which has a better possibility of outperforming in the near future. Even if slightly higher expense ratio is there, it doesn't matter. Eventually, that should deliver good returns for you. Google ranking. People select, especially DIYs. I don't think any mutual fund distributor will do that. He won't look at the Google ranking or any specific ranking, stars, Morningstar, Crisil, whatever it is. You look at the stars and select a fund. Look, these are like seasonal occurrences. You may see a 5-star fund today, but 2, 3 years down the line, it may not have any star. It may its star rating could change. So I wouldn't look at a star given to a mutual fund and pick it up. So I don't think that also has a great value for you in picking up your funds. Your mutual fund investment should be evaluated not on individual funds basis. Rather, it should be on a total portfolio basis. Let's say that you have put a lakh of rupee, or let's say you put a crore of rupee, and this is divided into 12 different funds. And these are in different buckets of conservative, hybrid, aggressive, main core bucket, and the tactical bucket. When you're evaluating, you should evaluate the sum of total. Don't evaluate individual funds. Rather, collectively find out what is the rate of return that they have generated compared to either the market or against your expectations. I've already told you a debt fund may look dwarf when compared to the equity fund, but debt never takes rest. It always keeps moving forward. If equity does not perform for 3 years, 5 years, the debt still performs at that point of time. And I'll tell you something which is a secret here. When you build your portfolio, there is no great charm in increasing your equity beyond 60%. If you increase equity portion in your mutual fund portfolio beyond 60%, it does not create extra return. It only creates extra volatility, up and down movement, right? So there are enough evidence, there are enough studies which have been done. If you maintain your equity, let's say between 60 and at the most 80%, the same return what you get for somebody who is investing 100% in equity, the difference could be not more than 0.5%. During this journey, you may say, oh, 0.5% is important. I do agree, but people will find extremely uncomfortable with the kind of volatility it creates. So if you have a 60-40 portfolio, any aggressive investor also can get the same return as a 100% equity oriented fund investor. That's something which you have to keep it in mind. Always keep some amount of debt, some amount of hybrids in your portfolio. That comes very handy. That saves you a lot of cash. Avoid churning your portfolio. Many of our clients also many times feel very uncomfortable with us. They say that you are not doing anything. You remove this fund, you bring something else, you change this. You constantly they keep telling us doing this. Remember, churning funds is not to your best advantage. Select right, sit tight is the best policy. If you know how to select the funds, if you know how to build the portfolio, if you know how to identify the opportunity, if you know how to size the opportunity, if you know how to maintain the exposure control, if you know how to use core and tactical buckets to your advantage, churning doesn't need to be done. What happens when you do churning? You get out of this fund and you enter somewhere. If you have made profits, you have to pay taxes then and there itself when you sell that fund. And the amount which is available for you to reinvest comes down. Many times, the biggest grouse I have with my clients is they keep pressurizing us, telling that you move funds in and out. We tell them, look, if you want us to do it, we'll do it, but we'll tell you it will not serve, it will not increase the returns in any manner. Rather, you will end up paying a higher amount of taxes and lesser amount of reinvestable surplus. This is what is going to happen. Avoid churning the funds, whether it is you are working with a distributor or whether you are doing it yourself. Your selection should be right and you should sit quiet. And that is possible only when you have a good level of conviction and an experience. The drawback of do it yourself investors is it takes them a long time for them to understand the game. By the time they learn, they would have done several mistakes. The cost of those mistakes are much higher than the cost difference between a direct and a regular funds. And moreover, they will be living in self-doubt and they will be having a time issue between their office, their family, and this financial matters. And that creates a kind of uncomfortable feeling in them. So it's a good idea if you get hold of a good distributor, mutual fund distributor, take their assistance and build your portfolio and relax and focus on your career and family life. One last bit of information for you is don't live under the belief that 100% of your portfolio should constantly perform. If the entire portion of your portfolio is performing, it only means you are riding on the risk. Some portion of your portfolio should always underperform. There should be debt, there should be equity, there should be hybrids. If all funds are showing the same amount of return, it means when the tide turns, all funds will fall together. But if you have something like a contra, which is not performing today, but its time will come. You have seen this happening with pharma, you have seen happening with IT, you have seen happening currently with the banking. So there will be cycles which keep coming, and you should have some amount of money which is in contra, which means that that part of the portfolio is not performing, but for having waited, it will give you super return when its time comes. That's what I say. Building a portfolio is just not scientific in nature, it's also artistic in nature. So these are all the finer points that you have to keep in mind. And what is the rate of return you can expect by investing in mutual fund? I'll tell you some of the guidelines which you can practice and you can expect. Number one, it is very safe to assume that mutual funds with a good amount of equity exposure will give you much higher rate than a bank fixed deposit. It's obvious, but it calls for time. While it is true that historically over last 30 years, it has given around 14% kind of a return, but it is not a guarantee that the future will be same. While it is easy to say the mutual funds give 14%, it is not a linear equation. The sum total of returns what you get was a mixture of mega return, ordinary return, no return, nil return, negative return. You add this all up over a 30 years period, that's where you get a 14%. When you're looking at one year, 2 year, 3 year period, anything could happen. But it is very safe. I'll give you two methods for you to know whether your portfolios are doing well or not. Number one, look at the bank FD rate, 10-year bank FD rate. If the FD rate is 7%, your mutual fund portfolio will give somewhere between 3 to 6% over and above the bank FD rate. Let's say if the 7% is the bank FD rate, adding 3, it becomes 10, adding 6, it becomes 13. So the broad range you can expect is 10 to 13%. If the FD rate rises, the performance of the mutual fund rises. If the FD rates fall, the performance of the mutual fund, expected performance of the mutual fund also falls down. So the simple way to know is look at the bank FD rate, expect 3 to 6% over and above that. If you get that, you are a winner. What's the purpose of investing? To beat the inflation. When the inflation is beaten, when your portfolios outperform the inflation, a bank FD rate is depending on the inflation. If inflation is 6%, FD rates will be 7%. So if you get 3 to 6% over and above that, the purpose of investing is served. Dear viewers, I have given you for the beginners, a comprehensive approach to investing in mutual fund. If it helped you to understand the finer points, how to do it, what to keep in mind, what to avoid, please do give me a thumbs up. Those of you who want to use our services, as I have said, drop us a message on our WhatsApp number, which is given in the description box below. If you find this episode very useful, do share it with each and everyone who might get benefited from watching this episode. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another thought on your life, your money next Friday. Till then, stay safe and Jai Hind.
Press the bell icon for more details and subscribe our channel.